Well, if you watched my video this morning, you know that I came up with 10 questions that I would ask, or if I had an opportunity this Thursday at the shareholder meeting, these were the 10 questions that I would ask in order of what I consider to be the most important. Well, one of those questions was whether or not Juniper would come out soon, like now, so that it could help us save the year in terms of unit sales of the Tesla Model Y. Right now struggling, at least and in particular in the United States and Europe, doing okay apparently in China from the latest reports. Anyway, turns out that Elon has answered that question, and the answer, sadly, is no. Will not be out this year, and did not indicate whether the rumors are true about it coming out in the first quarter of 2025. By that time, a lot of things will be going on that may make us all go, who cares? Because we can have all kinds of opportunities with the new Model 2.5, with whatever's going to happen with Robotaxi. Even Optimus could be a lot further along in terms of our understanding of what's going to happen. So, but right now, I'd really like to see Juniper come up. All right. There's a massive get out the vote effort going on to get all the votes necessary for Thursday's shareholder meeting. And Elon did supply us a little information that we could use to think about what's going on. And he says that 90% of retail investors who have voted thus far have voted yes. Unfortunately, he didn't also say how many of those had voted. Other people mentioned that the retail voters have about 47% of the shares not owned by Elon and his brother, because Elon and his brother are not voting, so they're out. So the retail investors have about 47%, so institutional, about 53% of the shares that are out there. Now, several people, including Tesla Boomer Mama, who are keeping track of all this, they were clear to say, look, we didn't get enough information from Elon to help us make any clear decisions with regard to how we think things are going to turn out Thursday. But the ones that are following this carefully seem to think pretty good chance, really good chance actually, that the compensation package will pass, and lesser, but maybe an okay chance that the move to Texas will also pass. Getting huge attention from everyone this morning is this amazing post coming from, oh, I'm so sorry, from 𝐓𝐿 𝐁𝐿. Okay, and 𝐓𝐿 𝐁𝐿 says, look, Elon Musk has been the key driver of AI and autonomy at Tesla. He's always pushed us to achieve great things, even when such ideas were seemingly impossible at the time. Oh yeah, the impossible. Back in 2014, autopilot started on a ridiculously tiny computer that only had 384 kilobytes of memory, and puny compute didn't even have native floating point arithmetic. He asked the engineering team to implement lane keeping, lane changing, longitudinal control for vehicles, curvature, etc. Many, even in the team, thought that the request was crazy. Nonetheless, he never gave up. He pushed the team to achieve this very difficult goal. In 2015, beyond all odds, Tesla shipped the world's first autopilot system. The second closest such project only came to market many, many years later. In 2016, Tesla started doing all of the computer vision required for autopilot in-house instead of depending on external vendors. Many people thought it was insane to bet on the product developing the vision system from scratch within a few months, which had taken other companies a decade or more. Yet, we achieved this target within 11 months. This was a strategically important move that started the development of a strong AI team at Tesla. Not only did he push for strong AI software, but also for powerful AI hardware. Tesla, which others thought was just a car company, was making custom silicon to run the neural networks efficiently I'm adding in this, in the car. This hardware that was originally designed in 2017 came into production in February 2019 and remains extremely competitive with hardware coming out right now. For reference, this 5-year-old AI computer has roughly 8 times the AI inference compute as the state-of-the-art Apple M3 chip. It is still able to run the latest end-to-end neural networks built on top of the latest AI technology. He was the one who bet on vision and AI to solve autonomy, instead of relying on sensor crutches and high-definition maps. For anyone who has experienced the latest versions of FSD, it might be obvious that it can that it can see all the important things and drive the car based on pure vision. However, back in 2020 and earlier, it wasn't obvious to most. In fact, many experts in the field ridiculed Tesla and Elon for these choices. We have proven them wrong by shipping supervised FSD to millions of cars and shown that with good AI software, the car is able to handle the complexities of city driving, such as making turns, handling intersections, yielding to pedestrians, just by seeing outside. In fact, we've even removed the radars and ultrasonics to just really focus on the heart of the problem, which is AI. Today, it's almost paradoxical that Teslas have the least amount of raw sensors, yet have the most autonomous capability compared to any production car. Pulling off such a contrary bet was only possible because of this extreme conviction and deep understanding of the problem. What have I been saying for years, starting with the Elon Musk method? The man has vision, and then he has the capability to not only communicate his vision to everybody necessary, the vendors, the employees, and the public, and the investing community. He has the ability to communicate that vision. And then once he's communicated the vision, he actually has the ability to execute on the vision. He goes on to say he kickstarted the work on humanoid robots at Tesla in 2021, again, before any ChatGPT or other obvious examples of the rise of AI. Just like the vehicle autonomy, Optimus is also being developed to be competent, scalable, and cost-effective in order to widely serve the world. I could go on, he says, but plainly Elon is critical for Tesla's success in AI. It is his combination of deep technical understanding, insane perseverance, and relentless hard work that have positioned Tesla to be the leader in real-world AI. Elon's technical intuition to make these important decisions way before others see it is unmatched. If not for Elon's ambition, Tesla might have dwindled to become just another car company. In the future, fully autonomous cars and useful household robots will be commonplace, and the world will think that this is just how it's always supposed to be. Until then, we need Elon Musk to push the frontier because he sees it already. And who knows what he might come up with tomorrow. That was my ad. Okay. Then, speaking of all that AI stuff and all that robotaxi stuff and whatnot, we have this from Tech Geek Tesla. He goes on X as John BBC, J-O-N BBC. After testing FSD 12.4.1 for 2 days, I'm buying more Tesla shares. I'm fully convinced FSD is on the right track. I hope this version goes wide soon. I'm editing a 4K video now to condense his 1.5 hour drive in downtown Chicago. And so he suggests you stay tuned for that. So check it out later and see how that video looks. All right, this is Randy Kirk. Please hit the like button. You know what to do. Hit the subscribe button. If you haven't subscribed, please hit subscribe. We need to really get the subscriber list up, and then hit notify. Tomorrow will be a normal, it's not going to be a normal week. We'll be talking about that in a minute. What a week ahead we have this week. But in terms of who's going to be on the show, so far, fairly normal. Brian White, of course, tomorrow around the noon hour. And then on Monday nights, it's just me. And then all the regular characters the rest of the week, all the people you've come to like and appreciate on the show. All right. And then join Patreon, go on down there and take care of that. All right. What is going to happen this week? It is going to be a week to remember. Fortunately, we have Monday, which will be light because the rest of the week's going to wear us out. So what is going to happen starting Tuesday? All right, so Tuesday will be my hardest day because this is a long, long report that comes out Tuesday morning early, and then I got to read the whole thing, not just the headline, this really requires a deep dive, and this is the NFIB, the National Federation of Independent Business Optimism Index. I don't have any idea whether Chairman Powell pays attention to this index compared to others. What I can tell you is, reading it month after month, I get tons of information out of it. One of the things that we've noticed over the last 4 or 5 months has been that these independent business people, these would be people that are in companies with less than 500 employees for the most part, and some with 1 employee or 2 employees. These individuals, when surveyed, are saying they don't need to borrow any money. They're not having any trouble borrowing if they need it, but also they just don't need the money. And I've talked about that in terms of this shift. If there's one thing that I'm talking about that nobody else is talking about, is the complete shift in the demographics of the world, but in particular of the United States, and the impact that's having. And what I'm telling you is these small business owners that have less than 500 employees, they are 50 to 75 years old, and they don't need the money. They've got 3 houses, and they've got stocks and bonds and pensions and Social Security. They don't need to borrow money to keep their companies going, and that has an impact on the overall market. Anyway, what do the people that were polled say? They think that the NFIB optimism index will go up from the low number last month of 89.7 to 89.8. That won't be much of an increase. I don't know why that would happen. I think the NFIB optimism index will go down. That's just me, just saying. Okay, and why? What are the NFI? What are these business owners been saying? They've been saying that they are still seeing inflationary pressures from underneath. They're still saying that they are having some trouble getting employees, although I'm expecting that one to go down a bit. And they're also saying that they don't have enough business. That's the main thing right now. That is switched now to being one of their major concerns. So let's see what they say tomorrow. I'm sorry, on Tuesday. All right, Wednesday, the consumer price index. What are the people who were polled, the economists and others who were polled say about the consumer price index? Well, they have a very rosy headline number. Remember, the headline number is the month-over-month inflation amount for the month of May. All right. Last month it was 0.3%. They're saying it's only going to be 0.1%. So that headline number might cause markets to go crazy. But if they're right about the rest of the numbers, then it'll only be about 15 minutes before the market will be not going so crazy and be probably going sideways, maybe even a little down, with more disappointment about the Fed's inability to lower interest rates, because they're saying the CPI year over year will still be at 3.4, which is what it was last month. They're saying that the core CPI will still be at 0.3, and the core CPI matters way more than the headline number to the Fed, and they're saying that'll still be at 0.3%, over 3.3% last month. And they're saying that the core CPI year over year will only drop from 3.6 to 3.5. That will not be enough to get the Fed to even think about lowering interest rates. So if they're right about all these, and I'm thinking that their optimism, their theory that it's only going to be a 0.1% on that headline number, I think that's nonsense. I don't think there's a chance in the world that that's going to come in that way. We'll see. We'll see what happens. All right. So later on that same day, we've got of course, the interest rate decision by the Fed. So that'll happen after all that. After everybody gets all excited about what happens with the CPI, then we get a chance to be excited again when we get the interest rate decision, which will, of course, be to maintain at current levels. It will not be to hike. It will not be to drop. It will be to maintain. So it probably won't have that much effect. Then we've got the U.S. federal budget deficit coming in, and that is predicted to jump from 210 billion to 301 billion. If you're ready for that. Then Jerome Powell, the Fed chair president, will in fact have his press conference as always, where he answers a bunch of questions. That happens at 2:30 Eastern time. And of course, we will report immediately after that press conference. So that will be an extremely exciting day. Of course, 2:30 Eastern time. He'll be done at 3:30. That's 12:30. I'm sorry, that's an hour. It's a half an hour before the stock market closes. So, there's plenty of time for people to react to his speech and to what he is saying about the future. And of course, what he's going to say is, we got nothing new. We got nothing here that can help us lower rates. And that's basically, again, going to be the kiss of death for September, in my opinion, and maybe November, but I really don't see it. I think there's no no reductions this year. All right. So in case that's not enough excitement for you on Tuesday and Wednesday, then we get to Thursday, we get initial jobless claims. Of course, those have been sitting in the 200 to 225 range for months. That's what's being predicted this week, 225. I have no reason to, I mean, I think they're throwing darts. That one, you hear me say that every week. I think the people that are guessing what's going to happen are throwing darts. Producer price index, they're saying it will drop from a 0.5% increase last month. 0.5 on the producer price index, the headline number, they're saying that's going to drop to a 0.1. Now that could be kind of one of these seesaw things where it was so high last month, it might drop down in order to bring down the average, but that will be not a good number. Was not going to help the Fed make the decision we want them to make. PPI year over year, last month was 2.2%. Nobody's predicting, or they haven't asked the question, I guess. Same thing with core PPI, no prediction. It was 0.4. Core PPI last month over month, was 0.4. And then the core PPI year over core last month was 3.1. Again, no prediction there. All right, so lots of stuff going on Thursday. Oh yeah, there's this other little thing going on Thursday. I'm thinking it'll probably be about 1 o'clock in the afternoon, Texas time. So that will, if that's when we get the vote. If we learn the results of the vote in the early afternoon, then that will impact the stock market. Otherwise, it'll be after hours. And of course, as soon as we have the results of the vote, I'll either do it right after the vote or I'll wait until after all the questions. Probably wait till, I don't know, we'll see. I might do it right after the vote. We'll see how it works out. All right. Then on Friday, not that much exciting, except we have the import price index last month that jumped 0.9%. And the pundits are predicting a flat this month. I don't know why they think it's going to be flat after 0.9% last month. Yeah, we'll see. Import price minus fuel last month was 0.7. They're not willing to guess on that one. And then we also get the consumer sentiment, the preliminary, the first one of 3 on the consumer sentiment. I think that's Michigan. Last month it was 69.1, which is really low. They're thinking it'll go up to 72.3. Once again, I don't have any reason to think that that's going to go up, other than the fact that it just might be that it was so low last time that this is a survey. Potentially the survey results would be, it's just that was really a bad survey month and maybe they'll be a little better. But other than that, nothing's changed that would cause the consumer to feel any better this month than last month. Well, anyway, we'll see what happens. All right. You have very likely considered some of the benefits and the potential detriments of AI. Have you? We got this whole AI, AGI, all the stuff coming forward. I know I've spent hours listening to videos. I've spent hours reading articles on AI and AGI and what the potential results of that are going to be. And what I've tried to do, and I'm going to have some videos coming out on this soon, is what does it really mean for you and me long-term, not just next week, not just next year. What does it mean in 3 years? What does it mean in 4 years? And I've got some pretty wild ideas. Well, yeah, not even necessarily that wild, that there is no good. Never mind. I'm not going to tell you that now. I don't have time to go into that. All right. So this is a new report from Fortune, and this is reviewing a recent speech by the second in command at the International Monetary Fund, to the extent that you trust them to say anything wise. Well, anyway, this person, in order to become the second in command of the IMF, obviously had some pedigree. So let's just see what she had to say. She says, the true disruptive effects of artificial intelligence on the economy and financial markets may not become apparent until there's a downturn, which could spiral into a full-blown crisis unless the risks of AI are addressed, according to the second in command. Her name is Jida Gopinath. During a speech at the AI Summit in Switzerland on May 30th, she's the first deputy manager director. What a title. Would you just call her vice president or something? Anyway, She said that discussion about AI's risks are largely focused on privacy, security, misinformation, and she leaves out, of course, the idea of running away and doing what it wants to do instead of what we want it to do. But much less talked about, she says, is the risk of AI amplifying the next recession. In a world of widespread AI adoption, the technology could convert an otherwise ordinary downturn into a much deeper economic crisis by disrupting labor markets, disrupting financial markets, and also messing up supply chains. So here's how she kind of spreads this out. You see, in normal economic times, she says, companies historically have tended to invest in automation, but then they hold on to their workers because they have the profits in order to do so. I'm going to question that analysis, quite frankly. Companies don't hold on to workers after they automate them out of existence unless they need them there. No, that's incorrect. But I think her point eventually makes sense. When companies cut costs in a downturn, workers are laid off and replaced by automation immediately. So I'm going to say yes to that there's definitely more of that. So she points out that IMF research shows in advanced economies, 30% of jobs are at high risk right now to AI substitution, 20% in emerging markets, 18%, almost the same, in low-income countries. But 30% jobs are high risk to automation in this current situation. So a much broader scale of potential job losses than we normally have, and that, of course, can spiral into something bad. Then she says in the financial markets, financial industry has long embraced automation and earlier forms of AI, such as algorithmic trading. The sector today is adopting newer AI technologies very quickly. She noted that some AI trading is being replaced with more complex models that can learn on their own. And forecasts suggest that robo-advisors will control more than $2 trillion in assets by 2028, up from less than $1.5 trillion now. So while AI can improve efficiency in that marketing effort in terms of stock market, the risks of AI are also more likely to show up in a downturn. We've seen this in the past where, you get to a certain level and all of a sudden all of these systems simultaneously go crazy. She says, and we know one thing is that no two recessions tend to be the same. Oh yeah, Larry Goldberg says that all the time. In such a scenario, AI could spur a rapid simultaneous move to safe assets, leading to falling prices, which I think is what I just said. All right, then what about supply chains? This is a little less effective. I know a lot about supply chains. We have Jeff Lutz, maybe I'll remember to ask him on Wednesday night about this, but she's suggesting that as these AI models become better and better, they might overstate what's happening with stale information, stale inventories, et cetera, and they might, their order decisions might be wrong in a recessionary situation. And I don't know that that's any more true than without AI. That one seems the weakest of her cases. Anyway, she says here are at least some ways she thinks could solve it. One way to ensure is that tax policies don't inefficiently favor automation over workers. Okay, now we're talking about what looks like a bad idea, but she says, look, I'm not talking about special taxes on AI. But she says another way to help workers with education and new skills, as well as strengthening the social safety net with more generous jobless benefits. Anyway, AI can be part of solutions such as upskilling, targeting assistance better, and flagging early warnings in financial markets. I believe there's a real need to have parallel efforts to make sure we're also AI-proofing the global markets. Okay. Anyway, that's what she had to say. Then this article here, fascinating article from MarketWatch. During the latest round of quarterly earnings calls, a FactSet analysis found the number of S&P companies that mentioned the word recession fell to the lowest number since the fourth quarter of 21, a year when the zaniness of the economy's reopening after the pandemic upended the job market and the world's shipping infrastructure and led to massive corporate profit margins. 29 of these companies uttered the word recession during those recent calls. That's well below the average for the past 5 and 10 years. Well, if you listen to this channel, you know that my number one rule about all markets is beware of when the feelings of investors get pushed too far in any one direction. We just saw what happened to gold, down 3.3% in one day. Silver down 6.6% in one day. So this is one I've been looking at for a long time. You know what my call has been. Last year, no recession because everybody said recession. This year, nobody thinking recession. So I'm at 30% right now, and I'm ready to tip in one direction or the other based on even stuff that comes out this week with all this crazy stuff that we're going to get to watch. It'll be a fun week no matter what. I mean, fun if you like to have a little, if you like your nerves on edge all week long. All right, tomorrow it's a calm day. Tuesday is when all the nonsense starts. All right, so let's take a look where the markets are as the pre-markets right now. We got to get to them first. All right, let's go with the bond market, which right now we've got the 10-year up another 2.1 basis points. Let's see if we got the rest of them. I think we do. Yes, we do. So 2.1 on the 10-year. We've got the 2-year up 2.7, and we've got the 2-month up 0.2. So what does that do to the inversion? Because we always take care of that. So we're really looking at 4.4 and 2-year 4.897. That is 45 basis points. So again, widened inversion. It's not started to contract again, widening out. But now we're looking at today's was the record breaker. Today was the 201st day or something. The longest one before this was 200 days. We have got the 2-month now at 5.387. So we're a little bit under 100 basis points. So that is contracting a little bit at this point, but not a ton. Okay, let's see what's happening to oil. We have got the oil right now is down another 21 or down 21 cents. Remember, it crunched last week down to like the 73 range, back up to 75.32 for Texas Intermediate, 79.44 for Brent, getting close to getting back over 80 again. Natural gas, another 226 up, sitting at $2.98. So now it's getting a little extended. So I'm not investment advice, but according to the Randy rule, it might be getting a little out there. Gold continues to crunch down after losing 3.3 on Friday, down 0.45 today, sitting at 2,314, 2,314. We've got silver down another 0.25 after losing 6.6 on Friday at 29.365. And then copper down 0.67 at 4.45. Copper now settling into kind of a range. It's still way up compared to where it has been, but way under where it got to, which was over $5. I think it was like $5.14, something like that. Okay, the dollar is bouncing more. It is obviously the bond market being up this much, that's impacting the dollar. Then you've got Bitcoin up 179 right now, 69,641, so back under 70, but pushing up against 70. And then the equities, very, very slimly not going anywhere. So the Dow up 5 or 0.01, S&P down 1.25 or 0.02%, and the NASDAQ down 5.25 or 0.03. So basically going nowhere, really flat. I think they're waiting for Tuesday. Quite frankly, I would be. I don't know if I want to be in the market until Tuesday afternoon after the Fed. Not investment advice. All right, so please, if you didn't watch my video this morning, that was a really good one. I'll put that one up right here. Go ahead back and check that out. And then tomorrow morning, we'll have After the Bell, then we'll follow that with Brian White. And that'll be it for tonight. I hope you had a great weekend. It's been great talking to you.